Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. Now it did happen, the SP 500 rejected off this line, off this trend line resistance that pretty much the entire world has been watching, and the index has broken a trend line support right here. If you join up the significant points of support, you can see it broke down that line, and arguably, we saw the same things in previous bear market rallies. In August right here, you had a breakdown before the rest of the correction. Of course, that seems obvious. For the market to move down, it first needs to break the uptrend. The same thing happened again in March right here, and you also have this MACD crossover every time, right, on each of these bear market rallies that really throughout 2022 have given you that sell signal. So is this what's in store for us? Are we just going to see a repeat of these corrections that we saw throughout 2022, in which case you could argue that the S&P 500 is due for another big leg down, and some people argue that we should see a massive move down on the S&P 500 right now. But isn't that too obvious? The number of amateur traders that would make a ton of money off that trade playing out would just be ridiculous. So trades that are too obvious, you should always be very skeptical, but we are going to talk about that in this video. By the way, if you are new here, don't forget to smash that subscribe button. We make these videos multiple times a week, covering what's happening on the stock market, putting everything into an entertaining, educational, and historical presentation. And if you enjoy the video, make sure to let us know by smashing that like button. Now, without further ado, let's get right into it. Before we get into the details of the short-term price action and what the market is currently telling us, I want to look at this chart right here and really highlight one of the key bearish cases on the market right now. Investors who are expecting a crash. This is a chart that summarizes their opinion very well. So before we take a look at some of the short-term stuff, I wanted to show this chart to you guys so that you have the broader context. If you are just interested in the short-term price action and you don't care about all of this, you're allowed to skip to the end of the video as long as you smash that like button. So this chart right here is the S&P 500, but it's divided by the M2 money supply. So this is basically a very easy way to understand why the S&P 500 goes up all the time. It goes up throughout history. Of course, since 1959, we've seen the S&P 500 print massive growth, but most of that can be explained by just the M2 growth, the total amount of money in the system. If you look at this ratio, well, we're exactly at the same level as we were in 1959. In fact, we're still at pretty elevated levels relative to the rest of history. And what do I mean by that is that this can actually be used as a metric for valuation. Where is the S&P 500 trading relative to the amount of money in the system? So basically that tells you how much money in total is stored up in the S&P 500 in the stock market. When it's a very little amount of money, that means valuations are cheap. When it's a lot of money, valuations are expensive. This is the dot-com bubble in 1999. So it's not a secret that since 2009, where valuations were pretty attractive, they were cheap, it was a good moment to be entering the market. A big part of what has been driving the stock market higher over the past decade has been bond yields being flat, because we've had, ever since 2008, ever since the financial crisis, we've had a very low rate environment where even the 10-year yield has been hovering around 1% throughout this decade. And so all of that easy money, all of that easy, cheap access to credit has propped up the market to very high valuations, even more so during COVID right here when rates were incredibly low. Now, believe it or not, we actually had a similar type of period in the 1940s and 1950s where rates and monetary policy was very low, right? Similar levels to the monetary policy we saw throughout the last decade. And this actually contributed to the rising valuations we saw between the 1940s, which came right after the Great Depression. Stocks were very cheap right here, but that easy money environment, those low rates propped up the market to very elevated valuations in the late 60s. So the argument that a lot of people have today to see the market go down is, hey, look at this. Rates are moving higher. Inflation has broken out. And so this is basically the equivalent of 1968, where interest rates were breaking out, going parabolic, and valuations were about to collapse, right? 1968 was right before valuations essentially collapsed. And in real terms, the market moved down almost 70 to 80% from that level. But I think that's an oversimplification, right? That could very well happen over the next 10 years, right? You can see that this phenomenon between around 1964 and 1981 took over 15 years to really play out. But in the near term, you can see what happened here. Valuations stayed elevated for a significant period of time and chopped up and down within that range before they eventually broke down. So let's pinpoint when those valuations broke down, and that is 1969 right here. That is when valuations broke down. When the 10-year yield, right, this is the 10-year government bond yield, went above 6.6%. Right here. It even went above 7% very briefly in 1969. So if your macro thesis right now is, okay, rates are going to shoot up to 7%, then by all means, go ahead and expect a lot more downside in the market, because if that happens, it's going to be a collapse of the stock market. It would trigger a large market crash almost instantaneously. But you can see throughout this period right here, look at where rates were. Well, they were hovering around 3.5 to 4.5%. They were basically stable right here for a period of 3 to 4 years, during which time valuations chopped up and down in this range. Now you can see where we are. We are at the bottom of that range. So you could argue that if we have the same period as we did in 1959 to 1964, you could perhaps see another thrust up. And then of course, if rates break out, then you're going to see a breakdown of valuations. Or if you have another 2008 financial crisis, you'd of course have a breakdown of valuations. But today, zooming in on yields, this is a parabolic trend that we had throughout 2022. We've never seen bond market price action that got so deeply overextended. The yield curve is extremely inverted, which means that the Fed basically can't get more hawkish than here, which is exactly what happened in August, right? They got more hawkish, which pushed the market down lower. That would really be a difficult scenario to see right here, because they are already so restrictive. They've already tightened monetary policy enough to trigger a recession, so it doesn't make any sense for them to get more hawkish from here. As George Soros often put it, the moment the yield curve is inverted is the most attractive moment to buy treasury bonds. And so if treasury bonds are rising, it means yields are moving down. So how does that all relate to what is happening on the S&P 500 and what's going to happen next on the S&P 500? Now keep in mind that short-term price action is incredibly difficult to time. Now if you want regular systematic updates on the different asset classes that we're currently watching, we have the lightning reports on gameoftrades.net, where we essentially highlight the entries, the exits, and brief summaries of why we like or why we don't like the asset, and all of that asset allocation is summarized on our model portfolio, both long and short positions. And the S&P 500 is actually not in the model portfolio, because our goal as investors is to beat the S&P 500. It's to have higher returns than the S&P 500. That is what our ultimate objective is as investors, and as an investment strategy service for you guys. It is to be better than the average, better than what you would get if you were just to passively invest your money into an S&P 500 index fund, or else there is no point. So we really focus our investment strategy on assets that are going to outperform the S&P 500, but of course, knowing where it's going in the near term can also be pretty helpful, because pretty much everything else trades relative to the S&P 500. While the technical picture does look worrying here, it's clear objectively, and in trading, ideally, you shouldn't have a bias. And when it comes to trading and technicals, especially pure technical trading, which you shouldn't have a bias. What we do is not pure technical trading, so I do want to incorporate other factors than just these pretty worrying signals, especially considering the fact that this is the fourth rejection of the trend line, meaning there's a huge amount of people watching this level. And I can almost guarantee you that now that we've seen the bearish crossover, now that we've seen the breakdown of this trend line, the amount of short interest that's coming in here to short the market for the next move down is massive, right? So that makes me skeptical of this move. And then there's what's happening on bond yields. Now, bond yields have been the most accurate market throughout 2022. They've been incredibly successful at illustrating the market market environment. And you can see most recently bond yields have broken down this trend line, this short-term trend line. So while the S&P 500 has rejected off the resistance, well, bond yields broke that corresponding level, right? And let me put up the S&P 500. You can see every time we've had a bottom in yields, it was quickly followed by a top in stocks. Bottom in yields, top in the stock market. Bottom in yields, top in the stock market. So the fact that bond yields broke down here is pretty promising, and it means that the bond market is being optimistic heading into the CPI now. Final thing I want to show you, let me put up the inverse of the 10-year yield so that you can see this very clearly, that the relationship between yields and stocks has been just perfect throughout 2022, and that has not changed. And we don't think that's going to change anytime soon. And you can see here, lower high on stocks here, higher high on bond yields. Very interesting that bond yields are being more optimistic than stocks here. Because again, look at what happened in August. This breakdown of the trend line is, right, you can make an easy comparison. Is today's breakdown similar to August and March of 2022? When it comes to the bond market, not at all, right? Not at all. Bond yields were pointing to more downside here. They're pointing to more upside here. So quite a different picture. This could end up being looked back on as a massive bear trap before the market moves higher, breaks this out, squeezes all the shorts that are piling up here, and brings us rapidly higher. Now, of course, that would only happen if the CPI comes in cooler than expected. I don't try and predict that kind of stuff, but if it does, you are risking a massive short squeeze here. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.